All right. Good morning, everybody. Wanted to share this with you guys. I came across it a little while back. I find it's a little laggy, meaning it doesn't update immediately. You can see the last cut that's shown here is from November, that 50 basis point one that they had given us, but it will update. This is a free website called the Zeta Economic Index. It has some AI built into it. It's just got a bunch of different economic pieces to it. So I'll share the link for that. It doesn't cost you anything. You go in and kind of take a look around, see how consumer spending, discretionary spending, and you get some kind of tell on what's been happening out there. Things like when Russia invaded Ukraine, whatever. It's it's free. It's just information. It's worth taking a look at. Otherwise, we've got a looming shutdown that we're looking at with midnight as the deadline. And that sets us up for a couple of situations that could happen. One, we could get a downgrade from Moody's no matter what. Even if they avoid the shutdown, Moody's could still come in and give us a downgrade. That is definitely going to send us lower. Two, they could pull a rabbit out of the hat and avoid the shutdown by the end of the day. That could pop us higher. Um, and or they could just throw up their hands and say, let it shut down and actually announce that. And that would send us lower. So we have a real threat to a significant downside move, a potential rip back up on a 0-day basis. We're not talking about, stabilizing after the fall or anything, just a 1-day, 0-day ripper, especially with the 0-day options on the table because it's OPEX. We're finally going to be done with the contract change. And so that's what we want to watch for. Plus, we're still getting more data, right? The data that came in this week has largely supported the idea that we don't need those cuts. Everything's fine. The market will get done throwing its temper tantrum, and then we'll see where we go from there. So looking at what's happening around the world, we've got Hong Kong down the least at 0.25%, and we've got the NASDAQ down the most at 1.5%, moving towards 1.75. Everything in the middle is just spreading out the loss. So for the day, we do have the PCE at 8:30. I think we've got a couple of Fed speakers chipping their teeth, and we're going to get some consumer sentiment at 10. And after that, it's going to be us focused on news, looking to see what they're going to do with this government shutdown or not, right? If they're just going to throw their hands up. Not really a bad day, all things considered. I would caution against running any sort of 0-day um, window, right? Where, like an iron condor play where you say, I bet price stays in this range. Probably a bad idea. Now, doing something like a credit spread or a butterfly, yeah, I could see that, especially a butterfly. They're cheap, and if you're wrong, you're not going to get hurt. I definitely wouldn't do any unbalanced flies or ratioed flies or even just a back ratio play, not on a day like this. Just straight up buy some OTM calls or puts, depending on which direction you want to go, or some butterflies. We do have some things that are up, right? Like not everything is down, but you don't want a market rally based on pot stocks and solar panels, right? That's not the droids we're looking for. So we are down to today's put wall, trying to find a little bit of stability there. I've got 58.50 as the next level lower since we went through the 111. We'll see. From this perspective, it's really hard to see the ADRs, so we'll swap to a different page. But we're underneath the 10-week, the 3-week. We've got moving averages down below. We've got a voodoo line at 58.50. It's a very large options level. And if we break that put wall, that's a really simple target. 17 points, $50 a point, 10 contracts. You get the idea. Pay the mortgage. That's not what we're looking for. So, and a common phrase is that if we get to the ADR early enough in the day, we can go to the other side by the end of the day. That really fits today. Going to the other side would put us at 6,000. It's a nice round number. It's close to yesterday's RTH high. I like it a lot. So if we do flip yesterday's high in the SPY, SPX, XSP, whatever you want to go for, that would be the target for an out of the money lottery, right? Something cheap, just throw it, put a butterfly on there, whatever you want to do, and it'd be a good way to go. And it's cheap enough that if you lose, you're not going to get hurt, right? It's like the tax you would pay on a cup of coffee at this point. Otherwise, if we don't turn back, you can take the entire ADR and give yourself 50% of that ADR and then 100% of that ADR to the downside. So right now, the average daily range is 1%. You would take another 0.5% and then another full percent, right? So we're down 1%, which makes sense because we're at the ADR. We would be down 2% or even 2.5% by the end of the day. But if you want the half, it would be down 1.5%. We got lucky that the ADR is basically 1% right now, so it makes the math really easy. I know how much everybody loves math, right? I get told constantly by new traders that they don't know how to do math. They don't like to do math. They don't think they're any good at math. You want to be a good trader? You better figure out how to do some math. Central pivot range. Right now we have an MDP. That's a missed daily pivot. We want to focus on getting back to that pivot in a flip. So while we may target yesterday's high as our final destination, one of the stopping points along the way in that run back would be getting to the pivot point 59.60. Just round up. We're not engineers here. Getting it down to the tick. It's close enough. 59.60, get through that pivot point, continue the drive to the upside, and get to the previous day's pivot point, 6,000. Now, keep in mind, 59.92 is a cog line, so we're going to have to get through that. 5,900 round number, we would have to get through that. 59.11 is another cog line. 59.32 is another one. Kind of get the idea, right? And those numbers won't change. They're static. They're always a cog line. So all the 11s, all the 32s, and all the 92s on the ES. You could do it on the SPX too, but I found that they work better on the ES. So all of those 11s, 32s, 92s. We've got some unconfirmed ones that are in other locations, but they're unconfirmed. So really just leave them be. Just a sneaky suspicion that there's one at 42 and 80, 81, 82. So a move to the upside would have to challenge all of that, right? We'd have to get through each one of those. We are setting up like a TRB setup too. It's a trend line breakover. So if you're not good at doing things like a trend line breakover, you could put on something like a 4-8 or an 8-17 moving average combo. Just do more than one, right? Two is better than one. Just like looking at things with one eye, sure, you can see, but you don't have any depth perception. Depth perception comes from looking at things with two eyes. Same thing with a moving average. Moving average can give you some insight. Two gives you depth. If you use a small pair like 4-8 or 8-16, 8-17, then it'll hug the top of this price action and it will be your quote trend line that we need to break over on the start of that run back up. Rather than you trying to get specific with your drawing and line it up just right and then be frustrated because it's not showing you what you think you need to see. As an MDP, it won't count today. It would count tomorrow. But if we get the flip and run up and hit it, it won't be an MDP anymore anyways, because, well, we would have hit it. MDP stands for Missed Daily Pivot, and that daily pivot is what we're talking about. So that's a good question. EMA or SMA? I promise if you put both on there, it won't hurt. Just for an example, 50 is my orange line here, and 200 is my purple line here. And if you've ever questioned why I have two lines, because one is an EMA and one is an SMA. And the reason I do that is because people always ask EMA or SMA. I promise it won't matter. Look how close together these are, and these are daily, right? So if you're using a moving average for the actual trigger to take a trade, the textbooks will tell you to use an EMA. If you're using the moving averages for bias and perspective, then the textbooks tell you you can use either one. That the SMA is actually preferred on the higher time frames if you're just using them for insight, not trades. So over the years, I've gotten to the point where I put both of them on there and I don't even change the line types so that I don't even have to question, oh, is this one the EMA or is that one the EMA? I promise it won't matter. So you do you. If you like the EMA, do the EMA. If you like the SMA, do the SMA. It would start to get a little different if you start using whole moving averages or triple moving averages, or, you start getting into all of those. Looking at the volume profile for the week, we're at a long ways off from what we would need to get back to this gap that needs closed. 61.32 is the point of control on the week, and it is the liquidity gap from FOMC at 2 o'clock. Even if we get back to that level, we're not safe because there's very likely a lot of unfinished business there, and it will close the gap, and we could sell off really hard when we get there. So A, I don't think we're getting there today anyways, but B, mark that spot because you're going to want to know when we get back to that spot. This sell-off from FOMC was one of the biggest sell-offs from an FOMC event in 23 years. This is a lot of people got caught flat-footed there, and I think there's a lot of unfinished business. So if we go back there, we're likely to see price respond. You're going to want that level on your chart. Having said that, we don't really have anything else of value here other than that 58.50 that we were just talking about, and then the point of control down here at 58.22. Below that, we have 5,800 and some structure at 58.11 cog line. So you can mark that out as a potential reversal point. And you can see how they defended 58.11 when we came down here before. I had just set this line and then we'll move it up. You can see the wicks where we got underneath 58.11 and they came in to play save a hoe and bought the market back up again. Multiple tests here on the left, and then in the middle we tested it again. There's a lot of structure down here. There's also the measured move on just your regular market dynamics. We need a market that pulls back, right? How many of you felt like this move was never going to end and you were waiting for your chance to get in on swing trades, and it just seemed like we were grinding higher and higher and higher and higher and nothing was pulling back to let you in? We all want that pullback, right? It's how we get the next leg. Well, these pullbacks have a known value to them. 5 to 7% is generally what we're looking for. And sure, it started to get a little smaller. These were like 3.25 or 3.5, and then it got down to 3. And there's these little mini ones. But we needed a good, solid pullback for a new leg up. And the sooner we can get that done, the better. So a little bit of negative news might go ahead and top us out. We get that 6.5, 7% move and be done with things and start the journey. Right. The problem is it very likely won't be a straight shot. So this one was like 9%, I believe. It went a little more than what we had wanted. And it took a while before we even got back up to where we were, let alone get the Busby off of it and then continue higher from there. The blue lines, the green lines here show one OPEX to the next, the triple witch, right? When we changed contracts. So was that a couple of months? It took that long just to get back to where we were for a continuation from there. So if we are going to get that deep of a move, what is this? Oh, 10%. I thought it was 9.5. 10.5% peak to trough. It could take 2.5 months to get back up there again. We're still not looking at something like the 2022 bear market where we're down for half a year and dropping 22 something percent. We're not looking at anything like that. We've got not even 5% yet. So, getting another 2 or 3% would be nice. We can just get it done this week and try to hurry up and get back out of it again. All right, still not a lot of help here on the 10-day profile. The TPO and the volume profile are lined up really nice. We can see that there was more volume than trades here at this 59.60 area. Other than that, it's a little bit of a warning or a hint that if we try to run back up, that 59.60 may be trouble. We already know we need to watch 59.50, so round number, options level, but this is telling you watch out at that 59.60 as well. We got a new VPOC, so we can wipe out this yellow one. That's from the December contracts. We only want to be using these cyan ones. And we're stacking them up overhead. When we do eventually start to run back up, we're going to have to take these off the table. Not today. That one got moved a little bit. Back to back, right? 17th, 18th, 19th. Each day we've gotten a new profile. So let's see what Friday has to offer. Hopefully we can run up, take this 19 off, get through yesterday's high, and then we'll see. Another thing worth considering is the half back of Wednesday. Wednesday's the dominant candle. It's the boss. It's in control. you're going to want to measure Wednesday from its highest point to its lowest point and mark the midpoint. Should be somewhere around 60.32, close to that, and which is a cog line. So that if we do get above yesterday's high and we continue that run to the upside, we get through, 6,000, 6111, or excuse me, 6011, 6032, which is the mid on up, right? Okay, we are more than 2.5% below the 10-day moving average. And when we zoom out, we can see, if I put my mouse here, that we've been lower than this before, but we don't usually stay there very long. During the bear market, we were down here for a longer period of time, but we were in a confirmed bear market. Other than that, we usually dip down and then come right back up again, right? We don't have a sustained relationship below that level. So we are negative, but we're looking for a bit of a mean reversion back in the other direction. I don't like the phrase overbought or oversold. I think it just confuses newer traders and gives you the wrong idea. We are certainly extended though, right? And it doesn't owe us a move back, not from this depth. But if we continue to expand and we get below 3%, 3.5% below the 10-day, I would be looking for some mean reversion, and we would start to use phrases like oversold. Even though that's just a really poor word choice, I think it should be able to do better than that. When it comes to the 10-week, we are below it, and it's the same thing. If we look back at how often we've been below the 10-week, we can see that, sure, during the 2022 bear market, we spent time below the 10-week. Otherwise, we usually just dip down and come right back up. Dip down and come back up. So that's what we're looking for, right? Just a little bit of flip, kind of like a reset, and then we're on our way back to the upside. We do have next week's range on the table, and it looks normal again. Remember, this week's range was broken. It's that tiny little sandwich up there. This looks more normal, but we can still check that at the end of the day. This is only a projection. It's not set in stone yet. You want to go in and validate that that's the true expected move for next week. And you can do that just by coming in and looking at next Friday. It's 161 at the moment. We want to look at this at 4:15 or later tonight. So after 4:15 on Saturday all day, on Sunday until around 1 or 2. After that, get closer to the Sunday night Globex, and this will start to move. So you want to get it when it's not moving over the weekend. And it's plus or minus, right? So if it says 160, then you take wherever we close at and you add 160, draw a line, take wherever we closed at, subtract 160, draw a line. That'll be your high and low. It should line up close to whatever this indicator gives. Just remember that this indicator, it can't actually read those numbers. Thinkorswim doesn't give us the ability in Think or script code to access this. So the guy who created that code, his name is Mobius, he came up with a way to mimic this number really close with that weekly expected move indicator that he made. I'm a coder for Thinkorswim, and I don't even understand what he did in that thing to make it work, but it works most of the time. Contract change events screw it up, but I mean, contract change events screws up TradingView, Thinkorswim, it screws everything else up. So if it breaks his indicator too, I mean, I don't really fault the guy. In this continued saga to the downside, if we don't turn back, the 20-week is on the table for the next stopping point. It's 5,800 basically. That's what you want to focus on, 5,800. It's another 90 points, right? So the VIX is up a little bit, not enough to meet our qualifications. Same thing with bonds. They're up a little, not enough. We have nat gas, and that's about all we have is nat gas. If we bring it over and look at TrendSpider, now we've got a little bit more. So we got transportation, pot stocks, the dollar, nat gas, and bonds are getting close. They're up 0.4. We need them up 0.5. They're just not there yet. I don't think we're quite ready for bonds to run yet either, but this would be a really good place to start, right? If they are going to flip it, this would be a spot where they would flip it. So this would be a really good start. We'd call it an LRE, low risk entry, right? From that 88 level. I would add some time to it if you're going to do it with options. At least use March, right? Give yourself a little bit of time if you're ready for that long in bonds. We got precious metals moving up a little, but they're not up enough to hit our qualifications either. Otherwise, things that are down, Bitcoin, cloud computing, uranium, consumer discretionary, chips, tech. I mean, the reason I was focused on the things that were up is because it was a very small list, right? Basically everything else is flat or down. So things that run high and far and fast tend to fall the most when everything changes, and weak things fall further. They have they're likely to get hit harder. And Bitcoin made some really fast moves in the last month, and it's getting hit pretty hard. But we've been stretched in software and chips, and it's a crowded trade. Now everybody's fighting to get out. And we're seeing some decent bleeding in that space. I started the week with us looking at this chart and talking about all of these that had that red leg on there. And we had two charts that were not showing that red leg, and that was technology and consumer discretionary. Everything else had that leg, right? Now what we want to get worried about is the ability for a lot of these to get back above the 200 period moving average. Like building materials is way under the 2. Healthcare also way under the 2, and energy. Others that are just coming into the 2 and may get a little bit of a dead cat bounce or a rally up into resistance. Utilities could get a nice little bounce here into the 80s, get up into that 50 period moving average from below. And staples, not only does it have structure here, it's got the 200 too. So we could bounce off of that, maybe come up into 82. Wouldn't be a bad little reflex. Industrial still has room to fall before it gets to that 2. So it's still the target. If you're looking for a short, industrials down to 29 makes sense. For a lot of these others, tech found support at the 50. We could dip under it, but like we did here, we dipped under it and found stability, got back above it. So we're not looking for the 200 period moving average on tech. Same thing with consumer discretionary. If this weakness continues, the 50 is the target. It's 217. It's a continued drop. Okay. Building materials, and that's just ugly. we don't have a signal of that turning around yet. And we'd have to go to a bigger screen and try to find something that it could hit to even start looking for a flipping point. Healthcare is the same way. What we got down there that it may hit, possibly offer a flip. So today, really want to watch and see what happens with this government shutdown. This came in really fast on people's radar, right? Because an agreement was made, everything was ready to go. There was no threat of a shutdown, and then suddenly, ta-da, there it is. And it can make or break it today. On top of that, Moody's, which is not connected to the government at all, they are an independent agency of their own, right? It's not the word I was looking for, but it'll work. If they come out and give us a downgrade because of this, which they could do even if the situation gets resolved, Moody's can still downgrade us. That's going to spin this market to the downside comparatively to what we saw Wednesday. Right? So, sure, look at the candles, watch the clock, play the news, but look for a really big reaction to either avoiding the government shutdown or them coming in saying we can't avoid the shutdown, that it's absolutely going to happen. And then the third leg of that, Moody's to come in and hit us with a downgrade. All right, everybody, enjoy your weekend. I'll see y'all next week.